Welcome to the AAA Storage Podcast, your integrated real estate and development partner exploring all things self-storage investing to bring you diversified success. Let's dive in.
Hello, Paul, and welcome back to another episode of the AAA Storage Podcast. Today, we are going to get really technical for our investors out there, especially the quants who like to build their own models and do their own due diligence. So the way we are titling this episode, and Paul, I need your help to break this down, but we're titling this Understanding Cap Rates, Yield on Cost, Development Spread, and IRR. Yep. And so the point of this conversation is that when you are evaluating a property or a project where you're going to be investing, obviously you guys and your team are doing your own due diligence and trying to understand exactly what the risk-adjusted return for the property, understanding the pro formas and building out the models to understand your profit on this project. And so there's some key, you said, analytical tools that you do that for. So you have these particular metrics for analysis, but also the return on the project overall, given what cap rates in the market are going for. And so help me understand, if I'm a real estate investor and I'm trying to assess these projects that you guys have and trying to understand how you're thinking about the value of this project, where do I start? Like, help me understand cap rates. Help me understand how you guys are thinking about yield on cost, how you guys are thinking about IRR. Just help me walk through that a little bit to break this down. Because and then at the end of the episode, I hope we can kind of put this all back together and get a picture of, okay, this is how we're determining the value of this property.
Yeah, I can't tell you how other folks do it, but I can tell you how we do it. We begin with the end in mind. So ultimately, we're driven by the internal rates of return that we can provide our investors. We've been able to perform consistently at high levels on that metric across our 30-year history. It starts with cap rates. Cap rates is a term, it's a concept everybody's familiar with. It's essentially the yield that is provided by the current net operating income of a property as a percentage of its cost. And it's how properties are valued in the marketplace. We focus on two other metrics in the analytic stage of a particular project that are predictors of IRR. So the first one is yield on cost, and we'll break that down maybe in a minute. And the second one is development spread. And yield on cost and development spread basically give us the ability, once we have a pro forma built out on a project and we've done the cost estimates so we know what the project is going to cost, to predict what our profit will be and therefore what our end terminal IRR to our investors will be. And so our current fund's an 8-property portfolio. Fund 2 that'll launch in Q2 will probably be at least that, if not 10 or 12 properties. And those analytics are applied individually to each one of those projects. And they sort of have to meet certain hurdles before we'll allow them to be a part of a fund portfolio. Because ultimately, our objective is to drive a 19 to 20% IRR, time value rate of return to our investors.
Beautiful. Okay. And you guys have this track record of doing this over the last 30 years, which is really, really impressive. And so getting through these hurdles are really key to understand if this property is worth investing in a sense.
Yeah. It's an analytic ability to project or estimate future profit from the development of a property. And you could apply it in non-development situations, particularly value add, where you're buying a multifamily project and spending some significant capital. That would apply to any property, but typically it's more of a pure development analysis.
Okay, great. Well, let's walk through all 4 of those components, just so our listeners are understanding kind of how we're working through it. So we have cap rates. Tell me about cap rates and how you guys think about them, but also generally in the market. I know this is a really common term. I've heard that a lot, but it's capitalization rates on a property. So tell me about that.
Yeah, a couple of things that I think are interesting, because I am a nerd when it comes to all this. I love the analytical side of our business, but cap rates are simply the yield provided by the current net operating income of a property. And so when somebody says that apartments in a certain market are trading at a 5 cap or a 5% capitalization rate, that means if you take the net operating income of that property and divide it by 5%, you'll get the market value of that property.
Cool. Okay.
I think what a lot of people don't think about is why cap rates are what they are. They are, first of all, the inverse of multiples, which is used in corporate finance for corporate acquisitions and corporate transactions. When people are buying companies, they use a multiple of cash flow or of EBITDA. One of the things that drive cap rates up and down in any market and in any property type is the likelihood of the continuance of that cash flow. So I'll give you a really broad example. In the hotel industry, where your tenant base turns over every night, cap rates tend to be higher than they do in a grocery store, grocery anchored shopping center, where your grocery anchor has a 25-year lease and all of your other shop tenants have 5 to 8-year leases. The likelihood of the continuance of the historical cash flow in the grocery anchored shopping center is a lot greater in a hotel. And that doesn't apply evenly and perfectly in all situations, but people wonder why cap rates go up and down. And that's one of the reasons why they vary. Interest rates also move cap rates because they are essentially a yield. If I buy a piece of real estate and it's giving me a 6% yield or cap rate, it's bought based on a 6% cap rate, and treasuries are providing a 10% yield, the real estate investment doesn't look very attractive at 6. That kind of dynamic will move cap rates up because you're always thinking in terms of a risk-adjusted return, with the treasury being basically a zero-risk instrument. Interest rates move cap rates. The dynamics of the property type, the likelihood of the continuance of the cash flow will move capitalization rates, and then also market supply and demand. We saw a phase in multifamily where both on the operating side and on the asset side, there was a real imbalance between supply and demand. There was a tremendous amount of demand for apartments from tenants, and a lack of supply. So it made the development of apartments very attractive, or the purchase of apartments very attractive, and drove cap rates down. At the same time, because there was such a supply and demand imbalance, there were more people that wanted to buy apartments or develop apartments. And so all of that together drove cap rates down. That in the multifamily space, that trend has really kind of reversed itself in the last 18 months, where there was so much supply created that cap rates have gone the other way. The seesaw swung the other direction. But that's just sort of an overview of cap rates. But they are essentially used every day by every type of investor in real estate because the value of a piece of income-producing real estate is expressed in the cap rate.
Okay, it's really helpful that you mentioned how you have similar valuation metrics, like valuing an equity investment, whether public equity or private equity investment, where you might have cash flow, return on cash flows, or the capital asset pricing model and beta. And if you adjust those numbers, you get a different kind of return picture. And cap rates is kind of like that. It's one of those numbers that you would adjust on a model to understand expected cash flows.
And the same dynamic applies. I know we're not here to talk about corporate finance, but if you look at two different types of companies, let's say you've got one company that has a subscription model, and so it has reoccurring revenue. And maybe that revenue is tied to contracts that are multi-year contracts. Another company is transactional. They have to resell their product or service every day to every customer. Let's say both of them produce $1 million in net operating income or cash flow on an annualized basis. The company with reoccurring with the MRR model, the reoccurring cash flow model, may trade at a 10 times cash flow or $10 million, while the transactional company may trade at a 5 or 6 multiple. So 5 or 6 million. The reason for that is the risk of the continuance of the cash flow. When I've got long-term contracts that are 80% of my revenue, a buyer can be fairly certain that cash flow is going to continue for a period of time, at least to allow him to recoup his original investment. The transactional guy is a whole different model. He's very sales intensive, and there's really no guarantee you'll have revenue tomorrow. And that same dynamic applies to real estate. Long-term leases, but you have to combine those in the real estate world with the other dynamics, supply and demand and interest rates and other things that are driving cap rates. But it's one of the factors that really impacts how cap rates move in the marketplace.
Beautiful. Okay, very helpful to understand that. Thank you for that analogy. So we've got cap rates, and the next one we've got is yield on cost. Talk to me a little bit about that. And I know we've had an episode on that where we touched it briefly, but given this more full picture about the quantitative analysis, how do you look at yield on cost and spread next?
Yield on cost is, to me, probably in combination with development spread, but is probably the most important metric as a real estate developer. And yield on cost is very simply the pro forma net operating income of a property once it's stabilized. So again, that's based on some assumptions. So your assumptions have to be solid and reasonable. But the pro forma net operating income of a property as stated as a yield or a percentage of its cost to construct. So give you an example, and it's the example I think I gave in the other episode when we were talking about things related to this. If it's going to cost me $10 million to build a self-storage facility, and our pro forma net income at stabilization is $950,000 annually, that property has a 9.5% yield on cost. But it's also one of the big reasons why we chose to really focus on self-storage and office industrial flex real estate. If you look in the market in general, across all property types, I would say the vast majority of developers are very comfortable with a yield on cost in the 7 to 7.5% range. In self-storage and in office industrial flex, the way we build it and the way we manage it, our portfolio yield on cost, we shoot for a target of 9.5. And that's a pretty big difference between 7, 7.5, and 9, 9.5. It's a 2% swing. And I'll give you an example in a minute when we talk about development spread, what that means in terms of return or profit margin in the development of a project. But it is the first indicator of the premium return that can be earned in exchange for the incremental risk that comes with developing versus buying a stabilized asset.
Yeah, I was going to ask maybe what is the reason for that difference? If 7.5 is kind of standard, but you shoot for 9.5, what makes up that difference and why is that important?
Well, part of the reason is in our portfolio or in our situation, we're pretty vertically integrated. So we can deliver cost of projects at a cost that is typically below what the market cost for someone else to build the same project would be.
Gotcha.
So that's a little bit of an advantage. Paul Shannon had a conversation with him on another podcast, and he called it an unfair advantage. I'll take that all day long. But the other thing is the nature of the product itself. The relationship between rent rates per square foot and cost to build storage and office industrial flex is simply a wider spread than it is in almost any other type of real estate. And just by its nature, let's be honest, in a self-storage facility, we're renting a 10 by 10 box with nothing in it, and we're getting $16 a square foot. That same piece of real estate costs $100 a foot to build. So you take $16 a foot, take out your expenses, and you're down at a net operating income level at $950 a foot in terms of your net operating income. So it's just the product by its nature has a higher yield on cost than office, retail, multifamily, all of those things. And in addition to that, we can build it a little bit less expensively than most people. If you think about, I don't know what apartment rents would be on a square foot today on a per square foot basis, but I'll give you this example. Everybody's familiar with a multi-story sort of fancy big box self-storage that's going up all over the country, mostly in more urban areas because land is so expensive. We build single-story drive-up self-storage. Those big box, I call them big box locations, cost somewhere around $160, $180 a foot to build because they got elevators in them. They have to have sprinklers. It's a whole different product than the single-story drive-up self-storage that we build. And they're all climate controlled, by the way. 100% of those buildings are climate controlled. But it costs them $150 to $180 a foot to build it. I'm building it $100 a foot to $105 a foot. At the end of the day, they're getting a small rent premium over us because it may be an in-town location and it may have nice shrubbery outside it, and it's made of brick, not a metal building. But the rent premium they're getting doesn't overcome the $60 to $70 a foot in cost that they have that I don't when you calculate yield on cost. So their yield on cost is coming in at 8.5, and I'm at 9.25, 9.5. And that's not exact math, but it's probably somewhere in that neighborhood.
Yeah, fascinating.
If that makes any sense.
Yeah, so seeing the larger picture from an investor, from a developer's perspective, you can see that, yes, that might look super fancy on the outside, but as an investment, it's actually much better to do the single-story drive up. And not to say that the single-story drive ups don't look nice. I mean, I know you guys make all kinds of landscaping decisions, paint decisions, things like that, but yeah.
Yeah. Well, the other thing is everybody thinks those big box stores are great until they've got to unload their stuff, put it on a cart, push it in an elevator, go up 3 floors, and push it down a hall.
Yep.
I've been pushing our marketing guys to do some billboards or some advertising with a picture of a guy like pinned against the wall by a sofa, trying to jam it in an elevator to get it up to his self-storage unit. Because the reality is everybody would really prefer drive up, where they can back the truck up to the door, open the door, and basically take 2 steps and put something down.
Yeah.
I think the single-story drive-up is a better product at the end of the day. But what justifies the multi-story buildings is if you're building in more urban areas where land costs are extraordinarily high, then going vertical does make a ton of sense.
Yeah.
But I think in a lot of cases, single-story drive-up's a better product. But that's a conversation for another day. So.
Yeah. No, everybody knows the last thing you want to do on moving day is have to go upstairs and in elevators and all that. That's the last thing you want. Yeah. Okay, I love that. You mentioned what apartment or housing square footage around different areas. At least I know in Fort Worth, Texas, I think you can get a good solid home at $250 a square foot, or a good solid apartment. So I don't know if that tracks where you're at in North Carolina, but that's where we're at in this market.
I just don't know what rents are per square foot. It varies so much by market, but an apartment project costs $280,000 a unit to build. If it's a 1,000 square foot unit, you're talking about $280 to $300 a foot to construct it. And I would say yield on cost in multifamily is definitely in the low 7s at best. There's more appreciation. You can grow value 2 ways. Cap rates can go up and down. That can make the value of your property go up and down. You don't control cap rates. The other thing you can do is grow net operating income, either by being able to raise rents or reduce expenses. In most real estate, reducing expenses, most real estate isn't super expense intensive. So it really becomes about driving, increase in top line revenue and therefore ultimately bottom line net operating income. The thing that multifamily does have is lower yield on cost out of the gate, but traditionally you'll see projections that are showing 3, 4, 5% annual increases in rents. And when expenses only increase at 1 or 2, you drive some significant growth in NOI over a 5, 6, 7, 8 year holding period that translates into, being able to sell that property for significantly more than you paid for it down the road.
I'm smiling because listeners should know this is like a masterclass in real estate investing you're getting for free from an expert. I just love listening to you because I don't know this stuff very well, so to hear you like kind of break it all down is like, man, I could take this and just like, I feel like I could just understand so much more about real estate investing because of you. So, okay, so we got 2 more. I want to make sure that we've got 2 more of these concepts: is development spread, and then how all that leads to IRR and built that fuller financial picture. So, talk to me about development spread and how you think about it.
Development spread is sort of a derivative, or it leverages off yield on cost, and it's simply the difference between your yield on cost and the market cap rate for that product. So if I'm building self-storage at a 9.5% yield on cost, and the market cap rate for storage in that market is 6%, my development spread is 3.5% or 350 basis points. And it's the one that begins to really point to and reveal the return potential of a particular project. Let's take a good apartment example. An apartment project with a 7.2% yield on cost, So that means the pro forma net operating income of that property is going to equal 7.2% of what it costs to build it on an annual basis, and a market cap rate of 5.
Sure.
That means they have a 2.2% development spread.
Okay.
There's a simple formula. If you divide the yield on cost by the market cap rate and subtract 1, you get the projected gross profit or profit margin in the development of that property if you sell it at stabilization. And in that example, it's 44%. If you take 7.2, divide it by 5, and subtract 1, you get 44%. In storage, with a 9.5% yield on cost and market cap rates at 6, so we've got a higher yield on cost, but the cap rates that value that property at stabilization are higher too, which means lower relative to the net operating income. We have a 3.5% or 350 basis point development spread. If you divide 9.5 by 6 and subtract 1, you get 58.3%. So
Okay.
the projected, the analytic answer to how much money could this project make if we build it on budget and we hit our pro forma net operating income, the answer is 58.3%.
Wow.
This is my simple example. We build a property for $10 million. It has $950,000 of cash flow, right? That's a 9.5% yield on cost. We get it stabilized and we sell it at a 6 cap.
Okay.
If we've leveraged that property, we put 30% of the cost in equity and 70% we borrowed from the bank, which is typically what we do. That means we had $3 million of equity in that $10 million project. We sell it for $16 million, round numbers. We pay off the bank their $7 million, and we have $9 million left that we send to the investors. All of that driven by the yield on cost and the development spread in that project. And at the end of the day, if we give our investors roughly back 3 times their money and we do it in 5.5 years, that's a 20% IRR.
Amazing.
And that's the play that we run. And we try, it's like running in football, it's like running off tackle. It is just, we just run it and run it and run it again. And that's in the simplest of ways, that's the thought process and the strategy that at AAA we've built our business on, and the ability to consistently return in that 19 to 20% range on an internal rate of return basis to our investors.
Amazing. Okay, this is a little bit of a curveball, but I want to emphasize, you guys have a track record of doing this for decades across dozens and dozens of deals, 90 completed projects, I think is the number. So you have this pro forma that you build before you go into a property, before you invest in a property. And you've got these numbers that you're trying to hit, and often you do, clearly. What happens during a project when you're building or lease up that might throw off that projection, if that makes sense? Is there something that you guys look for to mitigate against during the development of the project or during lease up that you need to mitigate when you're going through this process? Yeah,
we certainly... projections, there's only one thing I can tell you about every set of projections that has ever been done. It will not match reality.
Yes, right. Exactly.
Nobody is that perfect, and certainly we're not. A couple different answers. First of all, obviously, we're driven by those numbers. And so if we start to get cost overruns in a project, at that point, you're pregnant. You can't stop. Yeah. Then you have to look at what the alternatives are. Can we drive the rates a little higher in the marketplace? Can we... Rates and speed of lease up, which affects speed to stabilization, are all interconnected. So, if things are humming right at the right point, we may be super aggressive with rates to try to lease it up faster, to drive a little bit higher time value return. If we're off point a little bit on cost, then we may be a little bit less aggressive, accept a little bit longer lease up time. But there are things that are beyond our control. If you hit rock, when you start grading a site and you got to blast rock and it's going to cost $250,000, I can't fix that.
Yeah.
So the other answer is it's why we started doing multi-property fund projects. Because out of the 8 projects in Fund 1, I promise you will have one that underperforms and at least one that overperforms. And at the end of the day, the blended return across that portfolio will meet that 19 to 20% target. If you look at our history, we've got projects that have literally had an IRR north of 1,000%. And our worst deal ever had about a 2% IRR. If you were only invested in that 2% deal, that doesn't feel as great.
Yeah.
Fortunately for us, most of our investors have invested. They created diversification, not via a fund vehicle, because at that point in time we were doing single property syndications. They created diversification by investing in multiple projects with us.
Yeah.
So they might have been in the 2% deal, and they might have been in one that did 40. But we and that's why we went to the fund structure. One of the reasons was to create a little bit more consistent diversity for investors by putting a portfolio together that spreads that risk of projections being off, across more than one property. So
yeah. Okay, I love that. Because like I said, I know you guys have been doing this for a long time, but what they say is the map is not the territory. When you get to the territory, the map may or may not help you. So I wanted to see how you guys think through that. Another
reason why I'm fairly negative, I guess, not really. I've got some really close friends that are developing multi-story, all climate control storage, and they're great guys. They're smart. They've been super successful, and but I think I come across a little bit negative on that product. One of the reasons is the worst project we ever did was a multi-story project.
Interesting. Yeah.
In Houston, Texas, and we fought our way out of it and got all our money back to our investors with a small return, but it wasn't a pleasant experience. And I think that's another reason why that product doesn't attract me.
Yeah.
Fool me once, shame on you. Fool me twice, shame on me. So
That's right. No, you know what you like, you know what you're good at, and you stick to it. And I love that. Great. Well, Paul, thank you so much. This is seriously a masterclass. For those of you listening, this is extremely useful information. And so I highly recommend taking notes during this episode because it is that helpful. Paul, you are an expert. Appreciate you laying this out for us to understand how you guys calculate your the projects that you enter into and help investors understand what that looks like as well. And so I'm excited to keep going. Next time, we're going to talk about the capital stack as it relates to different investments or capital allocation that you can have regarding your investments. So, Paul, we're excited to meet next time, and I'll see you then.
Great, Brandon. Thanks.